Welcome back. In our previous lesson we spoke about the concepts of overbought and oversold, and we learned one way to use a stochastic oscillator. In this lesson we'll see a second way that the same oscillator can give us trading signals. Remember how I told you that an oscillator would tell us exactly when the markets are overbought or oversold? Well, let's see that in more detail. When the stochastic goes above the 80 area is this line that you have right here. If you go to the right, you'll see 80. When it goes above the 80 area, it indicates that the market is in the overbought zone. When it comes below the 20 area, it indicates that it's in an oversold zone. The 20 area is the other line that you have right here. You see on the right, it says 20. The problem is that being in an overbought or oversold zone does not necessarily indicate that it's now moving in the opposite direction. In other words, stochastic is not a timing indicator, and sometimes when there is a sustained move to the upside or to the downside, stochastics may remain in those overbought or oversold areas for extended periods of time. Let me show you one example in the chart. Suppose that we are right here, okay, and we see that a stochastic is already in the overbought zone. Well, based on the fact that it's an oscillator, we know that it should be coming down now. So let's say that we sell here, and let's see what happens. It starts coming down a little bit, but it goes back up. And look, surprise, surprise, it actually went a lot higher. Why? Because the stochastic remains in that zone, and it can remain in that zone for long periods of time. So that's not very helpful, is it? Now the question is there any other way to use stochastic effectively besides applying the divergence technique that we learned already in the previous lesson? And yes, there are two significant ways we can use stochastic. The first one is by waiting for both lines to come out of the overbought or oversold areas. In other words, if we want to sell, we wait until both lines have penetrated the overbought zone and then start to fall down out of the 80 area. For example, right here, the stochastic penetrated that zone, right? Both of them, and now it started to fall. We don't sell here, we wait until it falls below the 80 area, and now we have a safer trade. So the place to sell it would be once that it penetrates this 80 line or 20 line if we want to buy. For example, in this case, both lines have penetrated the oversold area, and then it starts climbing back up. Therefore, now we have the possibility to buy here. Okay, so that is clear. If we're looking to buy, then we apply the technique of waiting for both lines to have penetrated the oversold zone and then start to climb up above the 20 area. Not for example here. Okay, here start to climb up, but it hasn't gone above, so we wait until it goes above it. And there is a second way. The second way to use it is less reliable, but is also useful. You simply wait until both lines cross, and that gives you the buy or sell signal. However, you still have to wait until both lines have penetrated the overbought or oversold area. Once they are both in the oversold area and they cross up, then you have a buying signal. Once that both lines have gone into the overbought area and they cross down, then you have your selling signal. For example, right here, both lines have penetrated the oversold area, and now notice how the red crosses the blue. Well, that gives us a buying signal. Now let's see, for instance, this one right here. Both lines penetrated the overbought area, and now the red crosses the blue. That gives us a selling signal. However, as you can see right here in this example, it's not very reliable. Eventually it works because once that it crosses back up and it crosses back down, finally it falls under that area and gives us a safer trade. So this method will work, the crossing, but statistically it will give you a lot of false signals, and that is very important because that tells us that it would be better to combine stochastic signals with a clear understanding of what's going on in the market, which you have already started to build, and other trading tools that we will explore in future lessons. Now, TMT will strongly suggest that you wait until both lines come out of the overbought or oversold zones before entering the market. That will help you minimize the amount of false signals. I've prepared for you another chart, same chart but with some marks, so we can see interesting signals here. For instance, in this case, both lines penetrated the 80 area, it started to fall, and it gave us a wonderful signal. In this case, both penetrated the 20 area and are climbing up, and it gives us also a good signal. Here also gives us a good signal to sell, and say here also a good signal to sell. Here also a good signal to sell, a good signal to sell as well, even though for a short time. Good signal to sell also for a short time. Good signal to sell, much better. A good signal to buy. Another one to sell. This one was a fantastic one, also a wonderful one here. So you saw those in blue. Now I also marked for you some of those signals that actually failed. For instance, this one, both lines climbed up above the 20 area, and look what happened. Yes, it went up a little bit. By the time that both lines were up, we were almost at the top, and it fell. So that wasn't a good signal. It gave us again the signal here and right here, and it didn't work either. So it actually gave us a third one right here, and pretty much didn't work. I mean, you could have gotten a few ticks, but no more than that. So this one shows you that, well, those signals are not always perfect, but they are reliable enough. For instance, this one gave us a signal to sell, okay, but by the time that that signal appeared, we were already very low in the market, and in fact it ended up going up. This one here, both lines fell under the 80 area, and yet the market continued going up. This one also fell under the 80 area, and it didn't work for the market. It just continued going up. I think those are all of them. Well, actually, just visually you can see here how there are a lot more winning signals than failing ones. So, homework. This time your homework has grown, and now you have to do a lot more homework. First, you must identify all overbought and oversold areas in your chart. For instance, you identified that this one was overbought, this one was oversold, overbought, oversold, overbought, etc. Now mark the different buying and selling opportunities given to you by the crossing of the two stochastic lines. For instance, right here, they cross. See the red crossing down the blue? Okay, But remember, they have to have penetrated the area already. If we are going to sell, they have to have penetrated the overbought area and then cross down. If we are going to buy, we have to wait until both lines penetrate the oversold area and cross up. Okay, third, mark the different buying and selling signals given to you when the two lines come out of the overbought and oversold areas. Those precisely ones that I mark here, you mark them in your charts, in your different charts. This one is the ES 120 minutes, which is the one that we have been using so far, but you can use any and any time frame. 4. Take trades in your sim, of course, based on the different signals of the stochastic, including not only the crossing and the penetration of the 80 or 20 area, but also those from divergence that you already learned in the previous lesson and that we have still marked here. And 5, send those trades to us for revision. That's very important. Remember, you only have 1 month to send all your trades, so take advantage of that and send us all your trades for revision. I'll see you in the next video. In the next TNT, we're going to see how to increase exponentially the probabilities in your favor.